You ever stop and think about how you'd even begin to measure a country's entire economy? I mean, we're talking about all the buying, the selling, the building. How on earth do you boil all of that down into a single number? Well, that's exactly what we're going to unpack right now. I mean, it sounds kind of impossible, right? How do you capture the value of every single coffee, every factory, every tiny transaction happening all at once? Turns out, economists have some pretty clever ways to get it done.
So there are a few different ways you could go about it. You could, say, track the value that's added at every step of making something, or you could track all the income everybody earns. But one of the most powerful and honestly most insightful ways to do it is what's called the sources and uses method. And that's going to be our focus today.
Okay, so think of this as like the master balance sheet for an entire country. It's built on this really elegant, simple idea. Everything that an economy gets, its sources, has to go somewhere. It has to be used.
All right, don't let the letters scare you. This is actually pretty straightforward. On one side, you have the sources. That's all the stuff a country produces, plus everything it imports. And on the other side, you've got the uses. You know, how all that stuff gets used up. That's what we consume, what we invest, what the government spends, and what we sell to other countries. The key thing to remember, these two sides always have to balance. So let's start by breaking down the biggest piece of this whole puzzle.
And that biggest piece by far is consumption. This is the real engine of the whole economy, and it's powered by you, me, and everyone else buying stuff every single day. So when economists talk about private consumption, or just C for short, they're really just talking about all the goods and services that households, people like us, buy in a year to live our lives. Pretty simple, right? But the sheer scale of it might surprise you.
Whoa, yeah, it is massive. I mean, look at that. Private consumption usually makes up a whopping 60 to 70% of the entire economy. That means our collective daily spending, our groceries, our gadgets, our coffees, that's what really keeps the whole thing moving.
So what exactly are we talking about here? Well, it's pretty much everything you'd imagine. Groceries like tomatoes, a new washing machine, even a huge purchase like a new TV. And here's a kind of quirky detail. Even though that TV is going to last you for, say, 10 years, the economy counts its entire price as consumed the second you buy it. But there is one major exception. One of the biggest purchases a person will ever make, and it doesn't count as consumption, and that's buying a house. So if it's not consumption, what in the world is it? Well, that leads us right to the next letter in our big equation.
Right, so that house we were just talking about, it's not C, it's I, for investment. And that's because economists don't see it as something you just use up. They see it as part of building the country's future.
Now, this is a super important point. When an economist says investment, they are not talking about what most of us mean, like buying stocks or bonds. No, they're talking about something way more physical, way more, well, real. And that brings us to this absolutely crucial distinction between real investment and financial investment. What gets counted in the economy's big equation is only the real stuff, physical things that actually add to our ability to produce more. Think new factories, new machines, new infrastructure, and new homes. Buying stocks and bonds, that's financial investment. It's important, for sure, but from this perspective, it's really just shuffling paper assets around. It's not creating anything new. So, to put a fine point on it, the I in our equation is all about the creation of new physical assets. It's not about trading financial ones. It's about actually building up the economy, not just moving money around inside of it. Okay, so if this real investment is so important for building the economy, what makes it go up or down? Well, one of the biggest factors is something you probably hear about in the news all the time: interest rates. The connection here is actually pretty simple. When the central bank raises interest rates, it gets more expensive for businesses to borrow money, right? So that company thinking about building a new factory might hold off. Higher rates generally mean less investment. And, you guessed it, lower rates mean more investment. Sounds easy enough, but this is where things get really tricky for the people in charge. And this gets to the heart of the fundamental dilemma facing every central bank. They're constantly walking this incredibly fine line, this tightrope between two big goals: keeping prices stable, that is, fighting inflation, and encouraging the economy to grow. And their number one tool for this balancing act? You guessed it, interest rates. So let's just spell out that dilemma. If they lower rates, that's great. It encourages all that real investment we talked about, and the economy grows. But if things get too hot, you can get rising prices or inflation. So to fight inflation, they can raise rates. But
Doing that makes borrowing more expensive, which can slow down investment and cool off the whole economy. See the problem? It's a constant trade-off.
Which really leaves us with this huge question at the center of modern economics. If cheap borrowing and low interest rates are what fuel the investment that builds our future, why not just keep rates at zero forever? And as we've just seen, the answer is all about that incredibly delicate, high-stakes game of trade-offs. It's a balancing act between growth and stability that literally shapes the world we live in.